Welcome. You are listening to Purpose Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casino, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Mo Bina.
Welcome to Purpose Driven Wealth. I'm your host, Mo Bina. Today on the show, we have Shannon Robnett. Shannon is the founder and CEO of SRI, and he's a leading real estate developer and syndicator based in Boise, Idaho. With over 25 years of experience, Shannon has been involved in over $350 million of construction projects, and he's also the host of the podcast show, Robnett's Real Estate Rundown. Shannon, welcome to the show.
Hey, thanks, Mo. It's good to see you again.
Yeah, good to see you again as well. Shannon, I'd love for you to kind of start off by talking a little bit about your background and how you first became involved in real estate.
Well, I first started in real estate as an indentured servant because my parents were both involved in construction and development and real estate sales. So I didn't really have much of a choice. I grew up on the job site, cleaning houses, all that kind of stuff. And then as I got older, I realized that this wasn't really what I wanted to do. So I went to college because that's where all the smart kids were. And I realized I wasn't one of them. So about a semester later, I came back and really began to put my own signature on what my parents had been doing for 40 years. And, I'd watched my dad retire at 50 years old with cash flow, but still continued to put deals together and everything like that. And so I really got involved at that point. And from there, I realized that I could go to work as a merchant builder and I could get paid today, or I could go to work as a developer and a property owner and I could get paid forever. And so I really kind of then started down that road and began to realize that, there's a lot of opportunity in owning it. And if you've got to maybe sell one or two to get the rest of it done, whatever, but really out of everything you have, the last thing you want is to show a major profit from building something. You want to show the ability that you did something and that you were able to, create a residual income that paid you whether or not you ever step back on that job site ever again. So that's really kind of where I saw that coming from, is just really a lot of influence from my parents.
And you've been involved in a lot of development projects over the years. What types of asset classes have you developed?
I've done just about everything. I've done medical office. I've done multifamily. I've done subdivisions for single family homes. I've done multifamily, lots of industrial as well.
And have most of these or have all these been in Idaho, or have you ventured out into other states as well?
No, we've done stuff for development. We've got a development going right now in Florida. But we have primarily done most of our ground up development here in Idaho. And, as you guys have all seen from the news over the last 5 years, you guys are just figuring out that, this is one of the top markets in the nation. I don't know why I need to go throw a bigger net, So, I mean, we're doing all we can do, Mo. We really got a bunch going up here. So it's hard to want to go somewhere else.
Yeah, that's actually a great point. Boise's experienced tremendous growth over the last few years. But what have been some of the drivers for this growth?
I get asked that a lot. And when people ask me that, my go-to answer is, I guess you haven't been here. I'm looking out my window at my office here and I've got snow-capped mountains that are 40 minutes away and I can be skiing. I've got a lake that's another 45 minutes in the other direction that I could be boating. There's all kinds of outdoor activities. Our quality of life is phenomenal. Our cost of living, while it's gone up quite a bit in the last year, it's fairly low compared to most people. We've got a lot of strong job growth because Albertsons Food Stores is based here, Simplot Companies is based here, and Micron Technologies is also based here. So we have quite a bit for the community that we have. We have a lot of bigger jobs and stuff like that. But we also, during the pandemic, we grew our income. In the Boise area, the MSA went from $72,000 a year to $94,000 a year. And so we saw a lot of people that came in and moved in with a remote job for the lifestyle and have enjoyed what we have to offer as a community and everything else with everything else that's going on. And they're looking at it going, gosh, I can bring my remote job and I can live here. So we've had a lot of that over the last 5 years that's really kind of pushed our growth pattern off the charts.
Oh, and do you think those drivers are going to continue for the next 5-10 years moving forward? I mean, I don't see any reason why they would change, but
yeah. Looking back at 2008 and 9, 10 and 11, I mean, as I used to say then, this is a beautiful place to go broke. So if you're losing your tech job in Silicon Valley, you can still move to Idaho and be broke here for cheaper. I know that sounds funny, right? But I mean, when you're paying $5,000 a month for a 2-bedroom apartment in the Bay Area, where you can come up here and $5,000 a month will buy you a 4,000 square foot house. So it's a very different thing. And so I know that we do have the swings just like everybody does, but I think that there will be a lot more people choosing to move here as the economy cools, for the same reasons they were moving here as the economy was hot, because it's not like Austin or Dallas where you're moving there for the jobs and for the sectors that are there. You're really moving here for a way of life and a quality of life.
Oh, beautiful. Yeah, it definitely is a great market. And, I think over the last 5 years, at least on the residential side, I know it's been one of the top performing markets for residential real estate. How are things been on the commercial real estate side there?
Just as hot. There's a lot of, we do a lot of multi-tenant flex industrial. And there's been a lot of people that have sold out from, California appreciation markets where, they've been able to sell their 3-bedroom, 2-bath home for $1.5 million, come up here, buy one for $350,000, $400,000 and pay cash for it and then start a business. And so we've seen a lot of that where, people have opened up shop, whatever they're doing, we've seen a growth in that. And so our commercial sector has been just as hot. Office is up, just across the board. Everything has definitely been very, very strong in this sector.
And besides Idaho, are you involved in any other geographic markets or markets that you at least favor?
Yeah, we've got a single deal in Washington. We're closing one of 4 deals that we'll do in Houston this before the end of second quarter. And we've also, like I said, we've got a deal going in Florida for a national industrial tenant. So we have branched out into other markets and just trying to see where we can go.
Mm-hmm. You had mentioned multi-tenant and flex industrial. Can you talk a little bit about the industrial real estate space for listeners that may not be kind of familiar with it? And what is industrial real estate, and what are some of these kind of like nuances or sub-asset classes like multi-tenant and flex that you mentioned?
Yeah, the thing I love about industrial is, it tends to be, a lot of people think of the old steel yard that, their grandpa used to work at, or, a pulp factory where they're making paper or whatever. But, there's a lot of industrial that is, we had one tenant, was a 60,000 square foot tenant. All they did was stock cleaning supplies, but they would bring it in by the pallet, break it down, and then Cintas and all the other ones would come to them and get their cleaning supplies to then take to, your office locations or wherever. So you really get a wide variety of what that is. Another guy was a fulfillment center before Amazon had their fulfillment centers. But, when you get when you call the number at 3:00 in the morning, you get that multi-pack of vitamins with the stretchy thing and the this and the that, all of that gets put in a packet. So this guy's sourcing all of that, putting it together. So he's got a big facility like that. And as we've seen that, the thing that I see with industrial is that there's a whole different set of rules on how industrial is charged that I really like. And part of that is that industrial, you have your rent, and then you have either called CAM charges, which is common area maintenance charges, or you have your triple nets. And the difference with that, Mo, is as insurance goes up, as the cost of property taxes goes up, lawn maintenance guy goes up, all of that stuff goes up. That's all a tenant's expense. So that's a reimbursable to the landlord. So when you're looking at it in a multifamily situation and you say, hey, my rent's $1,700 and that includes, all the common area maintenance and the property taxes and everything else. Well, in an industrial setting, an industrial building, the tenant pays all those in addition. And the reason for that is because in a multifamily situation, you can raise the rents every year. Typically, those leases are, 6 to 12 months, right? They're not long leases, but in industrial, leases tend to be 5 to 25 years, right? We're bidding on a property right now that is a national chain that they have 2 more 10-year extensions, right? So they're in their first 10 years and they have 2 more 10-year extensions. And so they've pulled that out of the lease and said, hey, we'll deal with that on the side. So what you're really able to do is you're able to look at it and go, hey, my profits are my rents are my profits. Those are mine. Whatever happens with the water and the, city taxes and use fees and all that, that's a whole different thing. And so I'm able to really balance that and look at that from a different point of view. The other thing about industrial that I like is because there's long-term leases, they tend to be a little bit more secure. You can get longer term debt on them than you can in some other facets of the commercial market. Now, granted, you can go get HUD money and you can lock up your property for 100 years, 40 years really with HUD debt, but with industrial, you can get 25-year AM, but 10-year, 15-year call. Right. So you've got the same money for 10 or 15 years, which puts you in a place of stability that if you want to refi, you can, but it's not like a lot of this apartment stuff that's now coming due, which was, set on 5-year, 7-year revolvers.
Yeah, interesting. The industrial real estate space is actually, the last time I looked, at least, it was the best performing asset class within commercial for the last 5, and I think even the last 10 years as well. And even during COVID, a lot of the drivers, were even further strengthened, especially when you look at like logistics, real estate and warehousing. And you kind of mentioned at the beginning, a lot of people think of industrial as being like that manufacturing facility, in a very industrial part of town where they, like a paper mill or something like that. So warehousing and distribution is one that really comes to mind a lot. But what exactly is like flex space and multi-tenant space? Because that's one that maybe more people they see, but they may not actually know quite what it's like or what it does.
Well, you mentioned the large spaces, right? Like you got the Amazon 1,000,000 square foot buildings and all this huge space, right? The multi-tenant flex space is typically 1,500 to 10,000 square feet. It's your mom and pop shops, that the t-shirt printer. I've got a guy that makes batting cages. If you can, remember the net that goes over the tubing, and he has a special needs son, and him and his son have been doing this business for 22 years in one of my buildings, right? So, there's a dance studio in one of them. I've got window tinters. I've just all the little things that you think about that businesses are that need a little shop space to go with it, along with your transmission shops and other things like that. But you're talking about, all the different things where you've got the ability to store stuff. I have a golf supply guy, right? I mean, he swings around, he goes around all the golf courses and supplies their pro shops. So he's got, 100,000 golf tees in there and 95,000 Pro Vs in there. And he's got all this different stuff that he takes and puts in his trailer and then heads out for the day. So they're all of that little slice of Americana. I like to say that they're the first step out of your garage when you grow your business. And they're almost recession proof because they're the last step and your wife never wants you back in the garage. Right. And so when you look at that, I've got tenants in there. I've got one tenant in there that makes gelato ice cream. Right. Well, really what he has, he's got an 1,800 square foot commercial kitchen. Where is he going to find that setup with an 18-foot wide freezer anywhere else in town? So while the business has sold 3 times over the 23 years that he's been in my buildings, the business still stays, right? So it's all those little buildings. And the other thing is they're very sticky tenants too, because when they get in there, they build their business there. Their marketing says they're there. Everything about it says that they're there, and their customers know they're there. So when they move, it's a really big deal, right? And so they tend to stick around and stay, which is nice.
Yeah, definitely. Yeah, you want tenants that are going to stay. And And one of the benefits is another benefit of having a multi-tenant facility as well too, is that you've got multiple tenants, right? So, versus just like a single tenant, if something were to happen to that tenant, whether the business were to go out or whether, they have in whatever industry they may be, if they're having financial issues, then paying rent may become an issue. But when you have multiple tenants, and the same thing like a multifamily, right? You've got some diversification in terms of income streams coming in on that property.
Well, that's very true, Mo, and it's a great point. And the other side of that too is that, mom and pops don't close businesses based on bean counters making budget cuts, right? I
Yeah.
mean, we just heard about Amazon is, pulling back on all their warehouse and all their distribution because they wanted their fourth quarter to look good, right? So they say they're doing all this stuff and then it looks good on the balance sheet. Then you move it back the next time. I mean, there's just all these different things that you can do, but mom and pop businesses don't do that. They have, they've got employees and they've got things that they have to do and staff they have to pay. And this is really the only way that they make their money. They're not a CFO of a company that's got a balance sheet to push around. So they really tend to be, long-term tenants in the tens of years long.
Yeah. Very great point. If I'm a plumber and I've got an industrial space for my plumbing business, like, I'm not closing shop and opening up again, because like I said, I need to meet some kind of fourth quarter or third quarter, price to earnings or earnings target or something like that, right?
Right. Exactly.
With regards to the industrial space, are you involved? Are there any specific markets that you're doing industrial, or are you just focused just in Idaho within that asset class?
We're moving into Houston. I really like Houston right now. Because, if you look at the numbers, I mean, Houston's net absorption in the fourth quarter of 22 was almost 7 million square feet. I think they're on target to deliver 27 million square feet in the last 18 months. And they're absorbing it like crazy. Their port traffic is really one of the main drivers of that because their port traffic is up almost 30% since COVID started. Because if you remember, CNN liked to show that reel where you had all those ships out in the LA harbor, in Long Beach and everything. Well, people realized, wait a minute, I can't keep sending ships there. They're a month and a half to get unloaded. I'll take them around through the Panama Canal. It's only in the 2 weeks, and then we'll be up in Houston and we'll just distribute from that into the world. Plus, with the regulations on truck traffic and everything else that's happening in California, Houston is becoming a stronger and stronger port every day. So I really like those economics, and there's people moving into that market instead of moving out of that market. So you've got a blue collar, workforce that's there to take the jobs that are usually in industrial buildings.
Interesting. So in Houston's role in terms of logistics real estate, at least nationally, let's say, is definitely strengthening and, pushing forward, which also makes it very friendly towards also potential workers, and workers need to live in places. So on the residential and on the multifamily side, it also kind of goes hand in hand, right?
Exactly. Hey, by the way, I've got a multifamily building over here I can rent to your guys, right? But we're doing the same thing in Florida. We like the I don't want to call it the politics, but I like the business politics, right? I like the business friendly attitude. I like the environment where they're encouraging businesses to grow without bureaucracy. So at the end of the day, I'm able to get a lot more done quicker, and we're doing deals in Florida for the same reason.
Yeah, that's a great point. And at the end of the day, government has become so intertwined in everything that happens that, you can't really have a discussion, even if regards to investments, without getting involved in what the government is doing, right? I mean, what the government does and doesn't do on a local, state, and federal level dictates a lot of what happens ultimately, right? And so, and there's, as an entrepreneur, as someone who does real estate development, I think you want certainty, right? You want certainty, you don't want uncertainty. And so in places like Texas and Florida, there's a lot of certainty there in terms of, bringing a business and, investing money and capital and so forth.
Exactly. I couldn't agree more.
Yeah. Within Florida, are you also doing industrial real estate there as well too, or is that more just on the multifamily side? Or
no, we've got a large national granite importer that's doing a large single tenant building down there on the I-10. So we've got that one. We're looking at some other things, but again, same thing, strong growth markets, strong inbound traffic markets, and that all adds up to more and more opportunities. And when you have that, people think about, oh yeah, everybody's moving in and everybody thinks about, wow, we got to have more houses and stuff. They forget about the ancillary jobs that come with that. The guys that detail cars, the guys that, uh, distribute all of the satellite dishes and all that other stuff, all those different jobs that all fit into a warehouse space somewhere is really kind of what we like jumping in the backside and picking up.
Yeah. These different types of real estate projects that you're involved in, how do you typically structure them? Are these all syndication based? How are you raising capital, and how are you basically funding these jobs?
A combination of both. Some of them are syndications, some of them are my personal portfolio, but we do syndicate capital. We also have a fund. So, we use the fund in early acquisition and in some hard money type situations. But primarily when we're ready to go with our vertical construction, we go to the syndication model and take out bank debt to make sure that we've got what we need. And then, we typically go full cycle on a deal when the ground up is done, because that's really where the asset has received its most appreciation, but it's also had its most risk, right? So I use this analogy a lot. My dad and I are very different investors. I want growth. My dad wants passive income, right? So my dad wants nothing to do with the ground up multifamily project, even though he's been in construction and development for 35, 45 years, right? He wants it when it's done, and he'll pay a premium for it. He'll take it at a much lower cap rate to know that he has an asset that's brand new, that he can, for the next 10 years, not have to worry about maintenance and management fees eating him alive, and know that he's got good solid cash flow. So we'll typically build something, appreciate that, and then transact that to our second group of investors. That's a whole different group that's very into the passive income and the long-term hold portion of the project.
Oh, interesting. So essentially you're using the fund to kind of go out and get things started, maybe acquire the property.
Yeah.
And then from there, then you can maybe go to like a syndication model, and those investors that want to be involved on a maybe something a little higher risk and maybe like a value add opportunity can then come in and then be involved in a ground up development. And then I guess once it's stabilized, and now you can even have another group of investors, I guess, right, that maybe want to come in and do like the triple net thing, like you talked about on the industrial side, and get something more just like, your bread and butter, like monthly check type thing.
Yeah, that's a really good accurate description of it, because the reality is, when you built it, you've created the most value right there. I mean, we've got a project right now that will be done under construction with at about 54 million. That'll have a value probably close to 83, right? So there's a lot of equity created there, more equity that is created in any other time, and yet there's some risk to that, right?
Mhm.
Especially going into this market with higher interest rates. But that's what that's about. It's not a cash flow deal. There's not any cash on cash in these deals. But then you transact that, and go to the next group of investors and says, hey, we're happy with 4% cash on cash the first year, turning to 6, turning to 8, turning to 10. We're going to hold this thing for 10 years. We really want the long haul on this thing. It's just making sure your investor group, know what they're after, and making sure you're meeting their need when you're helping them invest with you.
Yeah, of course. Different investors have different risk tolerances and different
Yeah.
goals. And so the fact that you're able to cater to multiple investors depending on the life cycle of the project or the type of project, I think is actually really cool.
A lot of people try that one size fits all, and I have a deal to sell, so you must want this one. And, you might get the gal into one deal, but after that, they're going to go, this wasn't what I wanted, and I don't want to play this game anymore. So you really have to pay attention to your investor and what they're doing and how it's going and what their want is. And if you can't provide what they want, you're best off to refer them out to somebody that does have what they want, because they'll still value your opinion and come back for something else that you might have. But it's it's never a good idea to force fit an investor into your deal.
Yeah, I totally agree. And even the same investor over time will change their
Yeah.
goals and risk tolerance as well too, right? It just naturally happens. I mean, I'm sure your risk profile is different than it was 5, 10 years ago. I mean, mine certainly is. And so people just change, they want something right now that maybe wasn't what they wanted last year, the year before.
It's funny how your risk tolerance and your waistline seem to do that, don't they? Your risk tolerance contracts as your waistline expands.
Shannon, have you put on some COVID weight?
No, actually, I did, like everybody, but I think I'm on day 8 of a 21-day cleanse, and I'm actually down 10 pounds. But
Oh, nice.
the desk is hiding it. But I'm sitting there and I'm wearing a pair of pants that I haven't put on in 2.5 years because of that COVID weight. So I guess I was, wanting to relate it back to what I'm dealing with on my personal life.
Well, you look really sharp, Shannon. You look
Thank you.
awesome. Another topic I'd love to kind of get you to weigh in on is, one of these kind of, if you want to call it an up and coming trend or something that definitely is growing within the commercial real estate space, is fractional ownership through blockchain-based tokens, which we call tokenization. It's getting more and more steam. There's more and more opportunities out there that are being tokenized. What are your thoughts on tokenization? Is it something you've been involved in at all? Something you're looking to do? I'd love to hear what you have to say about it.
Yeah, we have actually been involved in it. I've tokenized my office building. And the reality is, when you think about costs, when I had a piece of ground that I'd gotten developed and entitled and everything, and I owned it personally, and I was deeding it to an LLC, which was also me, right? I was deeding it from I wasn't even deeding it to a new LLC. I was getting bank financing on it. And I had to pay $37,000 for additional insurance policy for my title insurance to reinsure so I was indemnified, but I also had to sign an indemnity form that I wouldn't sue myself for giving myself title to the property that I currently own and had previously owned prior to the loan that I'm putting on the property that I currently own. And the bank made me sign this too, but I had to pay $37,000 for nothing, right? Wow. So when you do that in a tokenized world, you're doing that one time and you're saying, hey, we're taking the office building and we're creating the tokens with it. And now we can transact in a reliable, immutable format that everybody knows that John Smith has 100,000 of these tokens, and now he's sold 20,000, and now Mo owns some and Shannon owns some, and we can follow that through the chain, the blockchain technology, without having to get involved with the scam of title insurance, right? Without having to deal with all these things. So you're seeing a lot of pushback on the title side, well, where's your title insurance? Well, if you've got the underlying asset that is originally indemnified and has title insurance, and now you're just trading fractional shares that are actually traceable and trackable through blockchain technology, you've got an amazing product, right? We've actually done this with the equity. We're getting ready to do it with the debt, where we come in and say, hey, here's a debt token that pays a cash on cash 6% in today's world, and it pays every month as long as you own the token. Then we've got the ability to create our own DeFi product, where we're DeFi financing with a cash on cash payment token, like a dividend token, and then having our equity and our ownership also fractionalized, and have that be allowed to be an ongoing thing. Because, one of the things that syndicators struggle with, Mo, is they have to sell the asset to make their money, right? There's not a lot of money for the syndicator after closing in the syndication. And so they've got to basically sell their baby to get their money, and nobody wants to do that. But in a tokenized world, you actually could then DeFi your equity shares in that deal, keep that deal forever, and or have people come and go from that deal because they could sell in and out. So there's a lot of versatility that happens in the blockchain world because of this technology. And all it is, it's a spreadsheet that everybody has. That's the basis of it all, is that all of us have the same spreadsheet, and that makes it immutable, which is unchangeable. So from the time we buy the building, we start the spreadsheet, we distribute all the shares. The day that Sally sells some, everybody records that change. Everybody has that on their own computer. So Dave can't come back later and go, hey, I bought Sally's shares. We all know the exact technology that distributes all that. So we all go, no, that's not what it says. That's the technology that will save us from the bank collapse type crap that's going on right now, because we know exactly who has the asset and that it's backed by something. So I think that what you're going to see from my point of view is that blockchain technology is going to accelerate in the financial crisis that banks are finding themselves in today, because they can't correct the problem because we've lost faith in them, right? I mean, when Silicon Valley Bank has $15 billion in losses on $16 billion in deposits, we don't trust you anymore. You lost all your marbles, man. So this the whole thing that you're going to see is now, what is the real asset? How do you give that ownership and make that ownership transferable? All of that is solved in the blockchain format. And now it's about being able to tokenize that and attach those documents to the tokens and have all of that kind of stuff happen, which is really exciting technology. And it's a place that we're playing full out in.
Oh, nice. And have you, and I apologize if you already answered this, but have you actually done this? I think you mentioned an office deal, but have you done this on any other opportunities in terms of tokenizing?
No, the difficulty with real estate is that real estate is not a fast moving train, right? So if you wanted to look at something that trades hands often, like a stock, that would give you a lot more proof of concept. Where you tokenize real estate, people get involved in real estate to hold on to it. As the market's flattened off and we're not seeing the fantastical gains that everybody was seeing in 21, people have gotten less anxious to go ahead and sell all of a sudden. So while the blockchain technology is great, it's still going to take some time to get everybody to adapt to it. That goes, okay, now I have it in blockchain. That's great. I've got it tokenized. That's awesome. Doesn't trade. It doesn't do anything different because I still want to stay in it. Right. So we haven't, I mean, while we've done it and we truly believe in the product and we see where it is going forward, we haven't rushed out and done a second and a third project yet. Probably do those a little bit closer to exits, because there are some people that may want to stay in and keep that asset, and more people wanting to bring fresh blood in.
Oh, it's a great point. And that's definitely one of the benefits too of tokenization, right? Is that, well, maybe we should take a step back, right? In a syndicated deal, right, these are typically long hold periods. And so an investor may have like a life-changing event, or for whatever reason may want their capital back. And so one of the drawbacks, right, have always been with these types of private investments, these syndicated investments, is the fact that, there's no liquidity out there in the marketplace. Like, who am I going to go to, right?
Right.
The documents basically, say that I need to go back to the syndicator, and, he gets, first dibs. And after that, who do I go to in order to sell these types of investments? How do you value them, right? They're private, they're not publicly traded, how do you value it? How do I find a buyer? All these other things, which a lot of it gets solved through tokenization, right? Because now you can have a marketplace set up where investors can then come in and buy, fractional ownership from other investors that maybe want to exit for whatever reason. And I think that type of liquidity also can be enticing for people that maybe before didn't want to get involved in a deal that was 5 to 7 to 10 year hold period, but maybe something that they may potentially be able to exit sooner, as long as, there are buyers out there.
And I think that, another thing that you bring up too, Mo, is that, there's a platform that's got to be built. There's a marketplace that's got to happen, and there's a lot that goes into creating the NASDAQ, right? I mean, there's a lot that goes into trading those securities, and how does that happen? And, there's just so many things out there, and we're, I'm very close with a couple of people that are working really hard in that space. And I think that it will be out very, very soon. But anytime you're dealing with, people's money and syndicated type products, you're dealing with the SEC. So there's another layer of complexity here, other than just setting up a popsicle stand where we trade, baseball cards. So I think that you'll see a lot happen in the space in the next 12 to 18 months. But until then, I think you're right. We're tokenizing, but, to what end and what does it really do?
Yeah, exactly. All these things just have to kind of be worked out. But definitely this is a trend that's, I think going to get more and more steam within commercial real estate, especially within syndicated deals, which I think is going to be enticing, and bringing in a larger pool of investors. And of course, there'll be the existing investors that have been investing the traditional way in these deals, who are probably going to be a little bit kind of like, well, I know a little bit about blockchain, and what I hear, it's kind of a Ponzi scheme, or it's a this or that, right? And so then there's going to be those people where it's going to have to kind of be like, well, no, it's not the way that you hear about on the television and so forth. And as we know, that's one of the worst places to get financial advice. But
Yeah.
I think there'll be kind of like that learning curve for everyone.
Yeah. Well, and it's funny that the people that are saying that it's a Ponzi scheme likely are ones involved heavily in the banking industry, which actually is the largest Ponzi scheme out there with fractionalized lending, right? This
Exactly.
blockchain actually shows what kind of fractional lending you're doing and what's happening with this. So you really have transparency that you don't have in today's banking system.
Exactly. Exactly. When some of these institutions are gambling with depositors' money, you don't know what they're doing.
Right.
You don't know what types of bets they're making. There's all these, financial products out there, right? That you don't
Yeah.
even know how they're being valued, right? It's all being done behind the scenes. So,
Yeah, exactly.
and at the end of the day, for people who don't know, when you put money into a bank, you are actually a creditor to the bank, you know. And
Yep.
so at the end of the day, good luck in trying to
Money's
get your
not
money
really
back.
your money. Yeah.
Exactly.
Yeah.
Exactly.
Sure.
Um, any last comments or anything that you maybe like to talk about or mention that we haven't already, whether in terms of like development deals or tokenization or just general market outlook, either in the residential or in the commercial real estate space?
I think the market outlook is not as bad as everybody's making it out to be. Everybody's thinking that there's a lot here that's like '08, and there's not a lot. I mean, we have interest rates that are similar to '08, but we have liquidity in the market. What we've got is we've got a lot of people that were using that 2%, 3% borrowing heroin. That is now, they're now at a place where they've got to retrade that loan. They got a 3-year lock or a 5-year lock that's now up, and their asset hasn't done enough that they can do a cash out refi. They're having to do a cash in refi. And so there's a lot of people that have great assets that are performing exceptionally well that are doing capital calls. And people are looking at that going, oh my God, it's a capital call. You must be losing money. Not necessarily, right? It didn't go per plan because so much has changed with our banking, so much so that some Silicon Valley Bank is going bankrupt holding treasuries. U.S. treasuries are the underlying asset that took that bank down. And so when you see what's going on in the market and you see what the bigger scope is, there's still a lot of great deals. There's still a lot of great value. There's still a lot of demand. Most markets are still under 4% for vacancy in markets. There's not a lot of rent abatement. We're seeing a pause in rent growth because there's just a problem. There's only so much money you can squeeze out of the poor tenant, and pretty soon they just can't pay it anymore. We're seeing delinquencies go up because rates have gone so high, and syndicators are trying to raise the value by raising the price, and there's only so much that people can pay. So I would tell everybody, look, be patient with the market. The market that you've seen for the last 18 months, 24 months is not a real market. That's a bubble. Okay. That's where the price went up, everything went up, and it's being brought down slowly, but that still doesn't mean we don't need housing. It still doesn't mean we don't need industrial, because we still need those products desperately. And if we don't continue to build those products and don't continue to develop those projects, we've got a whole class. Just think about this, Mo. We're getting ready to graduate another class of high schoolers that's estimated to be about 13 million little people, right? They're going to graduate, they're going to become adults, and let's just say a third of them go to college. Let's say a third of them stay at their mom's house. That means that we got 4 million people looking for a place to live. That's just with who graduated from high school.
Yeah, well said.
So, market's still strong. Market's still strong. Vacancies are low. And I think that if you've got a well-executed business plan, now is a great time to be buying.
Yeah, I totally agree. Something that people should keep in mind, at least on the with regards to housing, is that home builders underbuilt for many years, and there's still a shortage nationally of millions of housing units. So I mean
I saw an article today, Mo, that said that housing starts are up more than anticipated by almost triple. So where they, and I talked with a builder, he had 65 spec homes in March of last year. He started his last home April of last year. He's starting more homes now because he only has 10 specs available, right? So he's gone through that inventory because demand is still there.
Yeah, definitely. Well said. Shannon, how can people find out more about you and the different type of projects that you're involved in?
Easiest way to get a hold of me is just shannonrobnett.com. You can jump on our website there. I've got a book you can download. I'd love to have you swing by, book an appointment with me. My calendar's available. Love to chat with you further. But that's just the easiest place, shannonrobnett.com.
Cool. And we'll also include a link to that in the show notes for this episode. Shannon, thank you for coming on to the show today.
Thank you, Mo. It's always a pleasure talking with you.
Yeah, same here. Thank you. You provided an amazing amount of value to the audience. And thank you, everyone, for tuning in this week. And until next time, have a great week.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.